So, but today we are going to talk about how to finance your business and what those lending institutions really look for, and the different types of ways you might be able to put a loan package together for an institution. We're going to primarily look at it from a startup perspective. However, I do have an exercise at the end of the day, or at the end if there's time, and that's really kind of an exercise for people who have already been in business and reading financial statements, but it's related to the lending institutions and how they view your financial statements. And it can be related to the financial projections that you put together. And please, at any time and point, stop me and ask questions. I'd rather have that interaction. That would be great. Okay. Anything else as far as the introduction piece goes, Sherry?
Only that, as I mentioned earlier, that we did change the legal structures and the tax issues to that October 10th date versus the November 14th. That just worked well for the attorney and I guess the financial tax guy. So I think that'll be a really interesting one. So hopefully you guys can make that one too. So yeah, it keeps moving right along. And like you mentioned, we've got a local firm coming in September to talk about marketing the business.
Okay, so how do we get that money to be able to start? Just quickly, the Small Business Development Center, here's a little plug that we do. We help in regards to the business plan development, financial analysis, help putting together that loan package to get that financing from the lending institution, and then that market research piece. I was on the market research piece, we're going to be going to the University of Minnesota to get a lot of that market research done for clients. We used to go to the James J. Hill Library, but it closed. So now the University of Minnesota is kind of, well, it probably was always open, but now we know about that, and they're going to let us go on campus and be able to do that research. And they will let you go on campus and be able to do that research. And there you kind of access research reports that are good to go in your business plan to give to the banker to educate him about what you're going into. Because that's an important piece. Lending institutions and commercial loan officers are really good at assessing risk, right, and so on and so forth, but they don't really necessarily know your industry and how to go about it and the ins and outs of it. So there's a little educational piece that you have to do for them. Some key documents and data that you have to have when you're looking at this. So if you're an existing business, you'll have historical financials, right? So that's your profit and loss statement for last year or the year before. You'll also have projected data, and that's really what you're going to focus on as a startup. So that projected data you'll have, and then you'll have market data, and then you'll have some personal data. So these are 4 pieces of data that you kind of got to collect and put together and form together. There's a lot more documentation that goes along with this too, but that's kind of the key. Those are the key pieces. If you've got any questions, or if you feel like you've been through that loan process with the bank before, then please stop me and say, gee, Mark, I did this with a banker or a credit union, and we had to do this, this, and this. So that would be great to hear it from your personal experience too. So along with that data, it should include in the business plan your projected income statement, your balance sheets, you usually, if you're an existing business, you'll have business tax returns. You'll also have to show that lending institution your personal tax returns. You'll have to have your budgets together, so your business budget, and then in some cases, a lending institution will say, we want a home personal budget. They don't say that too often, But I think if they review your data and they look at it and they'll be like, oh boy, this person only lives on $10,000 a year. How did they do that? Then that might kind of say, oh, okay, we want to be able to kind of look at their personal budget a little bit. And then the personal financial statement and cash flows, and then you'll look at the equity contribution that you're going to make to your business. Meaning, how much am I going to put into my company out of my pocket? Your equity contribution, right? So they're going to want to see, the lending institution's going to want to see how committed you are. And you're committed with time. You might have quit your job. You might, you're committed to sacrificing your relationship with your children. I mean, you are committed to your passion. But when it comes to the lending institution, they want to see commitment through money. How much are you risking? So that's really what that means. Any questions on that document, on those types of documents that you would need to have before going into the bank? Everybody understand what's up there? Okay. And this isn't necessarily your first trip. Your first trip is just to sit down, to introduce yourself and say, hey, this is my idea. And are you interested in looking at something? So I think the more you communicate with that lender, the better it is. Because then you're building relationships. Because one of the key things, along with all the numbers and the evaluation of it, is about character. So they're going to want to kind of learn about your business savvy. In that discussion, they'll learn about your experience. In that discussion, they'll kind of learn about your personality and so on and so forth. So whenever you're sitting down with that lender and you're in front of them, they're kind of evaluating you. So it's good to be able to get in front of them when you can. Okay, so they're going to look at, right away, they're going to say, is this a startup business or is this an existing business? And if it's a startup business, a lender kind of has an uphill battle to try and get you funding because you're not proven yet, right? And it's riskier. So they're going to look at it very conservatively. So, but if you're an existing business, then you've got some ability to say, here, these are my past records. I'm up and running. I'm going. I got a good customer base. These are my revenues. This is my cash flow. I've got this much money coming in. I'm paying my bills, right? So, but in a startup situation, it's riskier. So your equity contribution is going to be closer to this 30%. So if you're going to the bank to borrow $100,000, the lending institution or that bank or credit union is going to say, well, if you want $100,000, we're going to have to see $30,000 out of your wallet, or maybe 20. But that's kind of negotiable too. And that equity contribution doesn't necessarily always have to come in with cash. It does really with your startup, but I've been involved with projects where, like a landscaper will go to the bank and they'll want to borrow, $60,000, and they've got, $20,000 worth of equipment, and and then the bank will do a desktop appraisal on that, and they might count that as an equity contribution to the business. So then they don't have to come up with as much cash. So that can happen with an existing business. But if you're really starting out, it might be 20, 25. And the riskier the business, like a restaurant, pretty risky. A lot of restaurants fail. I think 7 out of 10 in the first 3 years. It's a crazy stat. So the banks know that, so they're going to want a larger contribution. Make sense? And then who knows what collateral is? Collateral. So a bank traditionally will like to see a 1-to-1 collateral ratio. So if you walk in to borrow $100,000, they're going to want to see something worth $100,000. It's difficult to do that sometimes, especially when you're a startup. So that's a hurdle that's difficult to get through. But there's a tool out there that I work with and the SBA works with and SBA lenders work with, and that's SBA Loan Guarantees. And if you're short on collateral and the lending institution still likes your idea, then they do an SBA Loan Guarantee. And that's basically when the government backs you. I'll tell you a little bit more about that too. And then they're going to look at a ratio, and they're going to look at a debt coverage ratio. Who knows what that is? Yes?
That's where you do the calculations to make sure your business is going to make enough to cover the payments.
Yes. Yep. And when you do that calculation, it's really about how much cash you have. So it's really about your net operating income divided by your annual debt service. And I've got an example of that coming up too. But that's what your debt coverage ratio, and a bank really likes that because they're gonna evaluate that. And it's got to be at a certain level, usually 1.3 or higher, depending on the industry. Okay, of course, credit score. I think I talked about this a little bit last time we met, guys, didn't I? Except I don't know if I had this. Where are we at? We gotta be in the very good and the good to get your loan. This happens a lot. I sit down with a lot of people and they're just like, they just don't get past it because they're here or they're really close to here and the bank just says no. Unfortunately. So if you don't have that credit score and that's up there, then you spend some time on fixing that and getting that credit score built up before you go into the bank. Because they could kind of say no right away. It's a big barometer to it. There's some other gap financing institutions out there that we'll talk about that kind of have lower standards. But banks are tied to government regulations. And a lot of times when a small business is declined, the bank will say, well, you're declined because your credit score is this. They don't necessarily tell you the back end of that and say, well, as a bank, we've got to be able to, we're regulated this way by the government. So if we make too many risky loans, the government does not like that. So there's some really good reasons why you might be turned down by a lender. And if you are turned down by a lender, always get that letter saying, we have declined your loan because of these reasons. You want to make sure that it's clear to you that's the way it goes. Lender will also look at your repayment loan on a consistent basis, the experience in your industry. They'll also look at the global budget. They won't just look at the business numbers, but they'll also look at the personal numbers, and they'll kind of, when they do the loan analysis, they'll bring those two together. And they call it a global financial analysis. So I think a lot of business owners or a lot of people asking for loans don't understand that, but they'll bring those two together. And then, of course, the debt coverage ratio. And then, of course, they're going to just assess that risk level. And that's your debt to worth kind of ratio, and I'll talk about that later. That's another thing that they'll look at. Okay, any questions? You guys know all this already. If there's something I'm not touching on, please let me know. So have your budget in place. show that you're going to make money doing this business. Show the lender that you're going to be able to cash flow. Because if you don't, the lender is probably going to turn you down right away. Because they're not going to be able to make a loan to somebody who shows them a negative cash flow analysis. Yes?
So if you're a startup, though, you're guessing, aren't you, on your
Yeah.
cash flow?
Yeah, that's why it's hard for startups to get funded. You're guessing, you're making a really good educated guess, though.
Educated guess, right,
Yep,
but it's still
yep,
a guess.
yep, it's still a guess. That's where that market research piece comes in. That's where your ability to be able to convince the banker, because you're the salesperson, and you're selling that individual on, I need this loan because this area. So that market analysis piece is a good one. Right off the bat, I'm thinking, if you're in a community that doesn't have a bike store, and the community's 15, 16, 20, 30,000 people. Yeah, that's kind of a good sign that there's a need in the community. If you could do some type of local analysis and find out where those people are going to buy bikes now, or parts, or whatever or skateboards, or whatever else people sell in bike stores, then that's a pretty good analysis to say to the banker, well, you know what, there's this much leaving our community based on this particular industry. So it depends on the industry, depends on where you're going. So you can do it, you can prove it. But some industries are more difficult than others. Yarn shops. So there's some industries that are. I don't know if the yarn industry is really dying, but the notions industry as a whole is probably dying. But you got to be able to come up with the market data, be able to say, hey, there's a market, and I'm going to be able to positively cash flow this.
Is that kind of go back to using the University of Minnesota too for market data?
Yeah. Yep. In some cases, if you're opening up a restaurant, I use restaurant example a lot because I spend a lot of time in that industry. You might be able to find some market data where you can say, $12 million in the community is spent on people going out to eat. Okay, and then there's different levels. There's fast food, casual fast food, fine dining, and so on and so forth. So you do that competitive analysis and that market analysis to be able to say, you know what, I think there's room of 2 or 3% of that $11 million is spent on food for them to come to my place. Will a financial institution loan you 100% of your project? Yes or no? No, they generally will not do that. You'll have to come up with your injection piece. I've seen deals get done where the startup doesn't necessarily have the money, but their family and friends do. And so in that particular case, that money from the family is actually, and the bank actually asks for a letter that states that those funds are gifted to the business owner. And so if those funds are gifted to the business owner, then they will qualify that as an equity injection. In some cases, too, you can go borrow that money somewhere else and count it as an equity injection. Some banks will do that. Some won't. It kind of depends because that's debt. So you're going to have to pay that down payment is a debt, and you're going to have to pay that back to the bank. And you're really going to have to show the bank that you can pay the bank's debt back along with your down payment debt. So there's that way too to maybe come up with funding to come down to get your business going. Does that make sense? Clear as mud? Okay, so these are the different kind of sources that I could think of where you could go. Okay, so these are the different kind of sources that I could think of where you could go. And people can kind of get creative in this, but this is really and it fits the debt coverage ratio, and then you just get a conventional loan. If you're short on the collateral and if you're a startup, then they're going to want to do that SBA loan guarantee. And there's different SBA loan products and programs that we have. There's our state office, our state SBA office is up in Minneapolis with great knowledgeable folks who know all of those programs. And I know some of those too, but one of them that's popular is called the 7A. And this is that guaranteed loan program. So if you're short on collateral or if you're a startup and the bank likes everything about your project except it's just maybe still too risky for them. Depending on how much you borrow and how much your loan amount is, the government will actually guarantee anywhere from, and the program that they have, anywhere from 50% to 85%.
Is that even for a startup?
Yeah.
Okay.
Yep. And so there's some requirements there. If you do an SBA loan guarantee, you have to show the bank, you have to qualify at the bank first. So a lot of people kind of get confused, I think, where they're like, oh, I'm going to get an SBA loan. They walk into the bank and they're going to get an SBA loan. Well, it doesn't work that way. The SBA will not give a loan guarantee out to anybody unless you get that bank on board first. So when I put an SBA loan application together, I need a letter of commitment from that bank that says, yep, we've approved this loan for Paul, and based on getting this SBA loan guarantee. So you really got to sell the bank on your project. They got to be on board. That's a key piece. And I don't necessarily always, I mean, if you can do a conventional loan and not the 7A piece, that's great because there's fees here involved. So if you can do it without the SBA loan guarantee, that's great. But how this works is, let's say you got a $100,000 loan, and the government's going to give you it's going to give the bank a 50% loan guarantee, right? So that's $50,000 that will be guaranteed. So if things go wrong and you got to close, the bank goes through their whole process like they would in a normal process and collect all the collateral that you've pledged and so on and so forth. And if there's anything left, so let's say they sell your machinery and they only get 10, and the bank is still owed 40, right? Is my math right? The government comes in and reimburses the bank 50% of that 40. That's how that works. Any questions? Yes.
Is there any difference between a regular bank and a credit union as far as going for a loan?
No, not really. Not really. I think credit unions, they're set up a little bit differently, so maybe there might be different state or federal regulations for them. So they might have to do things differently internally. But you wouldn't know about that, and you wouldn't really need to know about that. Try them all. You know, I always tell my clients, go to where you bank now and approach them first. Yep. And then, you know, if it doesn't look too good and you still think you've got a real good plan, then maybe go to another bank, and then maybe go to another bank. There is a difference between when it comes to SBA lending, there's preferred lenders out there. That's usually your bigger banks. So Bremer Bank and Wells Fargo and US Bank, they have all their preferred SBA lenders, so that gives them the ability to process your SBA loan application a little bit faster. But your small town bank can do a SBA loan too. It might, I don't know if it's going to take any longer or not, but they can do the same. They can do the same thing too. So, but it's nice to be able to shop around, negotiate. I think a lot of small business owners kind of go in the bank and they're like, no, you gotta know your interest rates, you gotta know your terms, and if you've got some leverage, right? If you've got some leverage and they really like your idea, or even if it's your idea and it's been proven, then there's some room for negotiating. But if you don't have that leverage, it's kind of hard, right? You want them to come after your business.
Wouldn't it be a wise idea for somebody starting out, if you were going to be borrowing a lot of this, to incorporate first so that if worst case scenario, your business tanked and that you wouldn't lose your home and your personal property and that?
Right, so that's going to be part of your October 10th piece, but yeah, for sure, yep. And the bank is going to ask for a bunch of other documentation that we'll go through. But yeah, very wise, Peter, to be able to do that, yep. You want to try and protect your personal assets as much as you can. The other thing, though, is that, people say that all the time, but then the bank will say, well, we want you to personally guarantee this loan. So then you end up signing a piece of paper. If you want the money, you end up signing a piece of paper that says, yep, I'm personally guaranteeing this loan. So in the end, wherever there's collateral, your home, your boat, or wherever, the bank will try and get that for collateral. Second mortgage on your house maybe, or something like that, they'll try. Because they want to secure that loan to the best of their ability. That's their fiduciary responsibility. It's not like they're just doing their job by government regulations and standards.
You mentioned one other thing too, is if somebody is starting to work with an SBA situation and that, and you hire a CPA to do your fact write-up and that for the loan submission and that, you might want to really be careful of who you pick for a CPA.
Yeah, there's...
My experience on that is I had my bank president was all with me, helped work up the business plan even and stuff. We had all the facts and figures down, and I hired the CPA that I thought was good because he was doing the city books at the time. Mm-hmm. And the application got kicked back, and what had happened was the CPA had neglected to include the valuation of my real estate at the time.
Yeah.
Which was the biggest asset that I had.
So that's a good point, Peter. You gotta know your numbers. I work with clients and help them put together that cash flow and the income statement and the balance sheet, but they're your numbers, And I've had in the past, maybe once or twice, where a banker will call me and say, hey, you know what? You worked with Jim on this, and are these his numbers? Because they seem like they're your numbers. So I really don't, when I work with clients, I'm like, you have to define those numbers. They're your numbers, and you have to defend them when you sit in front of the bank. So that's that's important. You got to know. You got to know what's behind them. So other sources then, so sometimes if you're going after a $100,000 loan, and maybe the bank, you only qualify for, $50,000. You need another $50,000, right? So that's where this term gap financing comes in. That's where your local economic development authorities, your port authorities here in Red Wing, Your electric cooperatives and the Southeastern Minnesota Initiative Foundation, they all have those small, local revolving loan funds that can help. And the advantage of putting them into the mix is that they'll take a second position behind the bank. So the bank always gets paid first, right? And then if there's money left over, they'll get paid. So that's kind of one of the requirements that a bank would have. So if Sherry's looking at a loan here and a bank is involved, then the bank will call Sherry and say, okay, you're going to do this, and yep, we're going to do this, so you're going to take a second position on the loan, and Sherry will say, yep. Because usually the bank carries the larger portion of the loan, and they have more risk, and so on and so forth. But I really like these local funds because there are really good ideas out there and existing companies and businesses in the community that are needed, but yet they don't quite meet the lending institution's requirements. And that's where entrepreneurs can turn to those local funds. You can bring on a partner. You bring on a partner, though, for a good reason. Otherwise, don't get into a partnership. Get into a partnership for real good reasons. Otherwise, partners, it can get sticky. Private investors, I see more than a couple of times I like to see the seller financing piece. So if the bank if the business is for sale for $200,000, you only qualify for $100,000. You get a loan for $100,000, and the seller of the business, you do a $100,000 note with the seller of the business, right? So you can still get into that business. You can still get the loan, and you can still buy the business. So you have to have the seller's cooperation on that piece. And that happens. Be aware of paying too much for a business if you're thinking about buying an existing business. It's got a cash flow, and it can only support so much debt service, which comes back to that debt coverage ratio. So you can only pay so much for a company, and as far as cash flow goes. So do that analysis. Call me or your accountant or even your banker and have them do that analysis for you. Make sure that you're going to be able to have enough cash to operate. Then there's crowdfunding, and then the grant piece. Like I stated in the last session, the grants are kind of unique. Don't spend a whole lot of time chasing after them. If you've got something really unique, or if you're in an accelerator or a co-working space like Ignite here or other places, you're probably not bankable at all. But you've got a real innovative, neat idea. You might be able to look at those government departments like the Department of Defense. You might be able to go to that website, that SBIR website, and qualify for a grant. Yes. Very difficult to get, though. Very difficult, yeah.
If you develop something with government grants, then don't they own your idea?
Well, depends on what it is. Yeah. So it's negotiable. You negotiate it.
That's negotiable too.
Yeah. I mean, if it's something that they really want their hands on, they're gonna say, yeah. So yeah, you have to be aware of who you're partnering up with. Yeah.
It might be interesting. I know for myself even. I think I'll do a little research on it and that. But I know some years back in that there was a fellow that was a grocery salesman and that go to different stores marketing his products and that. And he'd done some inventing on the side. And he tried to sell the government his 1,000,000 round a minute gun.
Oh.
And that was pretty interesting to see how that evolved.
Yeah. Yeah.
He had a heck of a time even getting a showing from the government. And once they got a visual demonstration, they was an instant sale, but
Yeah.
I'm not sure what all led up to that.
Yeah.
That would be interesting.
Yeah, yeah. So those are some different ways to finance your business. Anybody else know of another one? If you don't have to borrow money, don't borrow money. That's a golden rule right there. So an example of a past project that I worked with, it was a salon. We had the business owner, it was a startup. The business owner had enough money down. Her experience level was high. She was going to share the risk with the 504 loan program, which is another SBA loan product, which we could talk about too if you want. You want to learn about that? It's a program that shares the risk with the bank. So a typical 504 SBA loan program is 50% of the project is done by the bank, 40% of the project is done by the 504 program, and then you come up with 10% equity. That's a typical 504 loan project. There's intricacies there if you're a startup or if you're not a startup, and there's some SBA government regulations that you had to qualify. But anyway, she kind of fit that. And the bank liked it because they can still do 50% of the project and still take a first position. And 40% of it goes off to the 504 loan program. Really good program. They have a really good refinancing program too. So if you need to learn about that, we can talk more about it. And then I can put you in touch with Dwayne Lee, who runs the 504 loan program in Rochester. But this particular person was very determined. But she got turned down. She got turned down because of personal tax returns. She made a lot of money doing what she does, but it didn't show on the personal tax returns. And that was a big red flag. I'm working on a project right now. It's a store that the tax returns don't show what the owner is saying the revenue should be or are. So there's that. And so when that happens, lending institutions is very difficult to do. It's very difficult for a lending institution to make that because they're basing that cash flow analysis off of those past historical data. And if that really isn't accurate, then it's going to be very difficult to get. Anyway, in this particular case, though, it was just her personal tax returns, and the bank said no. But she was so determined and willing to do this, she took the next 2 years. The banker said, you do these 17 things, and you come back to see me in 2 years, we will do this deal. And she did 15 out of the 17 things. It was amazing. And she went out and she bought her building. We got a 504 loan program. It was just a fantastic project to work on. But it took her 2 years. You know, it took a long time for her to do what she really needed to do.
Can you kind of give an example of what those things were that she needed to do?
It was making sure she reports all the income, and it was kind of a you know, in that business there's tips, you know. What else did she do? I think she came up with a larger down payment. She needed to come up with a larger down payment. And another way to get the deal done too is that on that 50%, the bank did a 7A loan guarantee. So it wasn't a conventional loan either. So that helped. That's what I remember now, Sherry. Yeah. But it was, yeah, just a great example of what determination can do because she was just, you know, turned down. She was turned down. Restaurant deal, I'm gonna pass on that. Okay, so lender's review process. These are some of the things they'll look at. Credit history, right? They'll pull your credit score, and then the cash flow, the history of the projections, the collateral. the character, like I said before, maybe the business savvy, the experience, the trust level. They'll want a personal tax return, and then they'll want the personal financial statement. So that's where you'll show all of your assets and all of your liabilities, and you'll come to a net worth. So they'll want to see that. And then other documentation, personal tax returns, a business plan, equipment lists, lease agreements, if you're involved in a lease deal. And then that's pretty much what they'll ask for. They'll also ask for, if the loan is going to go through, they'll ask for your actual documentation. I am registered with the state of Minnesota as an LLC, So they'll check their balances. In some cases, if you're buying a piece of property or real estate that might have contaminants on it, so they might want an environmental review checklist form or something. So kind of depends. Every project's a little bit different. And then here are some of the 3 key ratios. They'll do more than a couple ratio analysis, but the debt coverage ratio is a big one, and the loan to value ratio is big. And then and if it's an existing business, they'll look at your other ratio analysis, which we will look at later. Any past experiences with people in the room with going to the bank or credit union and getting loans? Any turn downs, any success stories? Sometimes it's, I think sometimes you walk into the bank and you've got a strong personal financial statement, and actually the best time to borrow money is when you don't need it. That's the best time to borrow money. So that's what those lenders will look at. So your loan to value ratio. So they'll look at everything that's got an asset. Yes?
Earlier, didn't you say that if you don't have to borrow money, don't borrow money? But then you just said the best time to borrow money is when you don't need money.
Yeah.
Can you clarify that for me?
Well, the best time to borrow money is when you don't need money. I think that is kind of my flippant answer to that's when you could probably get a loan. That's when you could qualify pretty easily.
Okay.
That's what I meant by that. Yeah. I'm sorry if I confused
But
you
if
on
you
that.
have the money, then is your original statement better, which is if you have the money, then don't borrow the money?
Well, it depends on what you want to do. So, because sometimes you don't want to, if you've got money and you need to purchase a piece of equipment and you're an existing business and you spend all your money buying that piece of equipment, right? And deplete your cash flow. It depletes your cash. And then you're going to be in trouble. So in that particular case, you've got money, but you don't want to use it for that equipment purchase. That's a really good example. You want to be able to go to the bank and match the loan amount or the loan with the thing that you're going to use the loan money for. So, and you want the right term associated with that. So when you talk about real estate, banks will go out 15 years, maybe 20 years on a commercial loan, mostly 15 years. But that's the type of loan you want for real estate. If you want an equipment loan, then your term should be more like 5 to 7 years, depending on the equipment. And that's the kind of loan you want for that type of asset. So you want to really match your loan with the asset that you're borrowing. A lot of people get in trouble with lines of credit. So they'll go out and they'll say, I need this piece of equipment, and it'll be easier and faster to get a line of credit, so they'll do it. But it's really the wrong way to finance that $20,000 piece of equipment. It's really the wrong way to do it. Because then he's got to go back to the bank. Usually that rate is variable. He's got to go back to the bank and renew that note every year. And then he can't use that line of credit that he has for some other things that would be more appropriate. You usually use a line of credit to purchase raw goods, your materials. Then you take those materials, you make your product, then you sell it, you get paid, the money comes back to you, and then you pay down that line of credit. That's really traditionally what a line of credit should be used for. Does that make sense? So that loan-to-value ratio, they're going to add up your value of the real estate, the equipment, the inventory, and then there's value in accounts receivable, the money that people owe you, right? And then they'll do an internal and they'll discount it. So depending on what type of equipment it is, you say it's worth $10,000, but the bank will have a formula and they'll discount it by 25% or 30%, and then they'll say it's not worth 10, it's worth 7. So they'll do that loan to value, and they'll come up with the ratio, and then they'll see if it fits into their parameters, their policies. Here's that debt coverage ratio again. So it tells the bank how much cash is in the business to generate to pay off the debt. Is there enough money to pay this loan back? And so here's an example. So let's say I have a business, or I'm projecting to make $50,000, and I have an annual debt service of $30,000. So I'm going to do the math, right? 1.6, what? 1.6 what? What does that mean? Well, it means when you're looking at ratio analysis, you want to do this, you want to say the phrase or the saying that has to kind of pop in your head is, for every dollar in debt I have $1.60 to pay it off. That's what's showing the banker on this debt coverage ratio. So for every dollar I have, I've got $1.60 to pay off. For every dollar in debt I have, I've got $1.60 to pay it back. So the bank will have policies in place, and they usually don't go below 1.3. Nothing's really, there's always a little wiggle room, but normally they usually won't go below 1.3. So in this particular case, if we put together financial projections that showed that your operating income is divided by your annual debt, and we come up with a 1.6, that would be good. So that debt coverage ratio analysis would probably pass a bank's test or a lending institution's test. Make sense? Okay, so who wants to do some more ratio exercise stuff? Any questions? Okay. Over the years, I've been to a few seminars here and there. So in this particular case, you guys are in business, and you're running a company. And what I've just delivered to you here is a balance sheet. So we're kind of taking reading financial statements 101. And so we're just going to look at the balance sheet. There's 3 key financial statements in the company. There's a balance sheet, there's an income statement, and then a cash flow statement. Those are your 3 key financial statements. But for this particular purpose, and looking at wanting to know what lenders look at, they're going to do an analysis, and we're going to look at some ratios that are based off of this balance sheet. So balance sheet is supposed to tell you all your assets, list all your assets, some of your cash, what people owe you, accounts receivable, what you owe people. There's an accounts payable line there. That's what you owe people. So you're kind of in this you're in this office company, and you're making, I think it's office manufacturing firm, and this is 3 years of your company. Any questions on that? Okay.
Yes.
Yes.
Okay, the very first one, cash under assets.
Yeah.
If
That's
it
it.
goes
Yep.
to the third year, why is there less money the third year than the first year?
Good question. Yeah. So as we, and there's really not enough time to kind of devolve it to really get into it. But in the end, this company is not doing very good. When we financially look at the ratio analysis and analyze this balance sheet, we can kind of tell that it's not doing very good. And you pointed out the first one. For some reason, for whatever reasons, they're running out of cash. Maybe for a bunch of different reasons. So we're going to look at, we're kind of going to look at the strength of this company based on those numbers. And the math is done for you here already, but you're more than welcome to do it and check it out again. It's fun. So I just wanted to look at the first two analysis. And we're going to really look at the current ratio and the quick ratio, and then maybe we'll look at the debt to net worth ratio too. But those things lenders look at when you're an existing company to see how much staying power you have, how strong of a company you are, basically how risky you are, and how much staying power you have in the marketplace. And in this particular case, it's the office furniture market.
Mark, I've got a question to something that I see come across my desk a lot with
Yeah.
clients is they have that high accounts receivable on the balance sheet. Here you're seeing it going up and up every year.
Yeah.
Why do people run into that, businesses run into that? I mean, I just had one today
Yeah.
too that said, well, you know,
Yeah.
they're 30, 60 days behind.
Yeah.
Something that as a business owner, people can kind of know what to do to kind of
Yeah.
not run into that problem, because I hear it a lot.
Yeah. It's neglect.
Okay.
And it's not having an accounts receivable policy in place, and it's not letting your customer know that you have accounts payable policy in place. So when that invoice goes out, it says, this is our accounts payable policy, pay within these terms, these days. If not, here's these penalties. And then if you don't do that, then maybe the next one is, okay, we're going to think about taking you to collections, right? So there has to be an accounts policy, an accounts receivable policy within your company that has some teeth. So that's one reason. And then just neglect, not having that bookkeeper that keeps on top of that. And it's critical. It's critical to be able to do that, because when a lender, getting back to what the lenders look at, they'll really not even look at that collateral piece. Remember that accounts receivable is, you could actually borrow against that. That's money people owe you. And a bank will loan you money just based on accounts receivable.
But they will ask you the age of your accounts.
Yeah, and if it's 90 days, they're not even going to look at it. 60 days makes them look really nervous. So you gotta keep up on that. I was gonna say another thing. Oh, that happens a lot in small family-run businesses, garages, where friends and family come in and it's like you gotta have your car, but they don't have any money. And so you fix their car, you buy their parts, and you got all this money into there, and then you let your nephew go with the car because he needs it to get a job, but he doesn't pay you, or he's very slow to paying you. That happens when it comes to family and friends too. On that, if you're not good at managing your accounts receivable, you're going to need a lot of cash to stay in business, and that's not going to be good. Okay, any other questions? So this particular piece here is the math. Can people kind of decipher the math piece to this? So let's look at the current ratio. And let's look at year one. Is everybody up in this corner here where my fingers are? So a current ratio is taking those balance sheet numbers, your current assets. So that number, year one, it says your current total assets on this sheet here are $437,000. Your current assets. And then you divide that by your current liabilities. And that's on your balance sheet. Are you guys finding that? So here they do the math for you. No, they don't. Not year one. So if you divide the current assets by the current liabilities, you're going to get 1.7. Year one. So they're doing that, and then in your analysis here with the cash, you see going down, right? What's the current ratio doing? Is it going up or down, or what's going on here?
Down.
It's going down. Year one, it's 1.7. Year two, it's 1.1. And then year three, it's 0.99. And so going back to that analysis of saying, for every dollar in debt, I've got this much to pay off the debt.
Need 1.6, right?
Yeah, but in this particular case, when we're talking about the current ratio, we're talking about that first year, we're talking about 1.7. So for every current asset dollar, I've got $1.70 to pay off some of those liabilities. Yeah. So it's the same analysis, but now we're looking at the current ratio. So as the company's assets go down from year 1 and 2 and 3, if you look at the balance sheet, you'll see those numbers going down, the assets, and the liabilities are going up. Is that good or bad? Bad. And then that ratio goes from 1.7 to 1.1 and then 0.99. And you're like, oh. So now their ratio is just below 1 to 1. So now this is telling me that these guys don't really have enough current assets, which is your cash, to be able to pay their bills. Bad sign. Bad sign, right? Now, lending institutions go to a book. It's RMA. It's an RMA book. Shoot, I forget the name of it. Somebody out there in YouTube land will know. But they post industry averages. So in this particular case, there's an industry average for the furniture manufacturing business that we're looking at. And that 1.8, that industry composite, if you keep reading across there, that's what the lending institution will look for when they're evaluating your company. They'll be like, industry average is 1.8, but they're showing me that their average is 0.99. This is not good. They're well below average, which is not a good sign. Make sense? Okay, so that really measures your ability to pay your debts, your current ratio. Now your quick ratio is even more conservative. So in lending institution, that next one, the quick ratio, the lending institution will look at that to dig down even deeper. Where are the cash flow problems here maybe, or what is their quick ratio? And that's where you add in the cash plus the accounts receivable. And then you divide it by the current liabilities. So in the quick ratio, they're doing the cash plus the accounts receivable. So then you go over the balance sheet and you look at the cash. And then accounts receivable, you add those two, and then you divide that by your total liabilities. And you get your quick ratio. That gives the lending institution an even better focus on, boy, can these guys pay their bills? So what's going on there? When you look at your 1, 2, 3 and the industry composite, what's going on? Good, bad, ugly? Yeah. Yeah, 0.38. So for every dollar in current liabilities, they only got 38 cents in assets to pay it. It's not good. And then along with this whole case study, it's kind of fun. I like it because then you kind of dig into it and you know, and granted, your guys are talking about doing startups and stuff like this, but once again, my point for showing this is lender analysis. They really dive into the numbers and they look at it. And then, yeah, and there's 14 of these ratios that you could do off of that balance sheet that I gave you that gives you an indication of how well that company's doing. Or an indication of, you know, boy, where can they improve? Based on using that composite industry number. This is a whole nother seminar that we could do, reading cash flow statements. If you want to come, it's great, because we'll go through all 14 of these, and we'll read the study and so on and so forth. But anyway, that's my point.
I think that's one of the things that I've heard small businesses saying over and over again, that they don't understand how to read those financials, and I think they get away from them, and it's intimidating. So I
Yeah.
think it is very valuable to even have this of an exercise.
Yeah, and as a small business owner, operator, you don't have to sit down and do all of this analysis. You have your bookkeeper or you have your accountant do it, but you got to understand what current ratio is. You got to know what that is. Where do I fall? It's like, oh, I'm always struggling for cash. How come I'm always running out of cash? Well, let's look at that and let's see. Maybe it's your accounts receivable. Your quick ratio is terrible. Well, it's because you're not collecting on your accounts receivable, right? Yeah.
Is that what that would mean on that second line on the first sheet, accounts receivable, where it goes from 169,000 to 167 to 270?
Yeah. Yeah. So maybe they're I don't have the income statement with me. We really should have the income statement and the cash flow statement to really do that analysis. But I think what's happening is their sales are going. They're really selling a lot. And they're moving. So if you look at this company and you see their sales increasing, you're like, yeah. But in actuality, their management is suffering. And when their sales is going up. So their company's getting worse. They're selling more, but they're not making any more money. So that's a lesson where you say, you know, boy, just because you've got more sales doesn't necessarily mean you're making more money. You got to manage your accounts receivable. In this particular case, you got to manage your labor, and you got to manage all those other pieces too to the pie. So just because you got to improve sales in this particular industry. Yeah, and I think that's what's happening. They're actually, really increasing, but they're growing too fast. That's what's happening. They're growing too fast. I see that a lot with small business owners who are in the service industry, where they're just, it's like, oh, when do I hire on that next person? Because I'm growing, but when I hire on that next person, it means I got to pay them $35,000 a year if they're, entry-level CPA or whatever it might be. It's like, okay, well, I got to have this much more business to be able to pay them. But they're growing. They see customers, the phone's ringing. Hey, let's hire somebody. Let's get them going. But they need to do the analysis. Okay, any other questions? Concerns? That's, so just some tips to take to the bank. Best time to borrow money is when you don't need it. Always communicate the positive and the negative with your lending institution. Invite that lender to your business and let them communicate with them. Develop that business with them and make sure they know where they're at. Rates are negotiable. Borrow smart. That's where I said before, if you want a line of credit for your product inventory, then get a line of credit. Don't use a line of credit to buy a piece of equipment. So match up that term, and borrow smart. Be smart about it. Some more info. And then, there's lots of resources out there too. So, if you're searching for a specific answer, or you're looking for something that you really need, then call me and I can point you in the right direction. And we can figure it out. So. Any other questions?
Is it, like we were mentioning in our last class, that SCORE is a real great resource too.
Yeah.
I think it can be very intimidating for people to go in and talk to bankers and other financial institutes. Can they kind of coach you on some of that too?
Yeah. Let me just pull up their website. And they really have a good library. There's some really good information. They put on webinars, understanding basic financial statements, kind of like just what we did, but maybe even in simpler terms. You can blog. They got tools. They got great. They got good templates that you can use in regards to that. Personal financial statement templates, template gallery, business planning stuff, business plan presentation template. So really good stuff. It's right there. Like I said, I really like SCORE's. I go here a lot. It's better than SBA's and it's better than ours, SBDC's. So, yeah. And there's a SCORE chapter here in Red Wing down and access through the Chamber of Commerce, right? Yeah. I can guide you through all of that. We'll do it together because it is important that they be your numbers. That's important.
And like I mentioned, typically are requesting that we go through the SBDC as down with Mark. So we've worked with, like I said, Mark for many, many years and trust those numbers because he's really made you kind of dig deep. So he takes the time to really help you. That's nice. And it's free. It's important.
Yeah, it's hard. I mean, a lot of small businesses fail. I mean, it's difficult for bankers to do startup loans to small business owners. You really gotta be strong. You gotta have a good idea. You gotta prove to them that there's a market. You gotta have enough money to throw at it. Difficult to do. And boy, depending on what you're getting into, don't count on really pulling a salary out of there to live on till you're, maybe year 2 or 3. If you're starting up a small marketing consultant and you got all your knowledge up here and you got customers, well then, and you don't have employees and stuff like that, well then, yeah, you probably make some money right away. But it's going to take time to get that going. Excuse me.
So does that mean you have to have like 3 years worth of money to start up?
Well, on this website, they have a great break-even analysis tool. So that's really a good way to look at how long is it going to, what do my sales levels have to be at for me to just break even? And if you're not breaking even till year 3, then yeah, you got to have some money. You got to have some money on the side to keep those stores open. A lot of small business owners go into their business undercapitalized. So they don't have enough money. They got a great idea, and maybe even the market's there, and they got a lot of customers, but they run out of money. They don't have enough money to keep the doors open. But it's kind of intuitive to say, hey, we got customers, we got money coming in. We're going to have money. We're going to have money to pay off this debt. But it doesn't really work that way. I mean, because, excuse me, other things happen, and just because you've got a bunch of money coming in, you got a bunch of money coming out too, and if you're not managing it right, you got to have those funds, those working capital funds in place to be able to grow your business. You can't necessarily just do it with the money that's coming in from your existing customer base. Does that make sense? And that's kind of hard for some small business startups to realize. Especially if you got employees, especially if you got a lot of overhead, especially if you're renting or leasing a place. If you're just kind of solo doing it on your own, then yeah, then you might be all right. And your spouse makes a good living, and she's got the health insurance, or he's got the health insurance. Big things. Insurance is a big thing. I run into a lot of people, they want to start their own business, and they're on a good health insurance plan now, and they don't start their small business because of insurance. There's no way they'd be able to afford it, which is a bummer. But it's critical to have. Gotta have it.
Is there anything they do statewide as far as small businesses getting together as a conglomerate to be able to get health insurance? Because you're right, that's one of the killers of.
Yeah, the Affordable Care Act had, I'm not exactly sure, but they had a business component to that. But I mean, there's no easy solution to it. Yeah, I mean, there's no website that you can go to and say, oh, yep, I'm a small business owner and I qualify for this. I mean, it's still an issue. It's a problem. And we just continue to let your legislators know, and there's got to be a better fix to it all. So, all right. Anything else? See you on October 10th.
No,
No,
September 12th.
September 12th.
Let's not rush this.
Sorry. September 12th.
Yeah.
For the marketing. Yeah. You're welcome. Thanks for coming. And if you got any side questions, give me a call anytime or shoot me an email.